Will higher interest rates create lower prices for food, gas, housing, and more? We're going to explore this topic, so stay tuned for the full episode. Welcome back. This is Richard with Wisdom Investor. We've got a real good one here today. We're going to look at the possibility of prices coming down because the Fed is increasing interest rates. Now, some industries do get hurt by rising interest rates. Then others benefit by rising interest rates, such as retirees. They can get a higher interest on their savings. So we're going to explore this topic here. Leave a comment if you have any suggestions. Here's a chart here showing housing costs versus average wage. The blue line is housing cost index. The red line here is the average wage of a non-supervisory employee. And you can see the disparity between the two. And you can see why people are very concerned with inflation and they want to see prices start to drop. Here's a 62-year-old historical chart for interest rates. As we said, the Fed is trying to raise rates. Over here at the bottom right, interest rates are starting to go higher. Interesting enough, each time these interest rates go higher, we get into a period of recession, these gray lines. Back in the 80s, they had to raise rates to all-time highs, and of course, what followed was a recession. Here's a chart of the national unemployment rate. You can see right now we're at 3.6%, very low. So the Federal Reserve here is trying to balance unemployment so that unemployment doesn't get out of hand, because what happens when unemployment starts to take off? A recession will eventually follow. So there's a balance between unemployment and raising interest rates so that we can stay out of a recession and have what they call a soft landing. So what do you think about this soft landing concept? Are they going to be able to raise interest rates and keep unemployment from increasing and at the same time causing prices to go lower so we can drop the inflation rate? What do you think about that? Leave me a comment. Let's talk about housing. Can housing come down? You can see back here around 2006, housing prices peaked out. The Federal Reserve raised rates, caused a recession. Housing prices did come back down to the average wage. And then, of course, we've had inflation. Housing prices have increased again. So the goal here is, can they get housing costs to come down and maybe touch this line where the average wage is? Because right now, it's out of proportion. The cost of a house is more expensive than the average wage. I think they're going to be able to bring the cost of housing down. As a matter of fact, in many areas, the cost of housing is starting to come down. But can they maneuver a soft landing, or is this going to cause a lot of destruction in our economy? Are people going to start getting laid off because of the high interest rate? We're looking at a 70-year-old historical chart of the cost of oil. You can see we're very close to the peaks that we had back in 2008 and also back in 1980. Raising interest rates doesn't have a direct effect on oil. So we all agree we've got to see the price of oil lower. Now, how are we going to see the price of oil come down if the Federal Reserve has very little control over oil? If the Federal Reserve raises interest rates, this may slow the economy down. Therefore, the demand for oil won't be as great as it is now. Now, a couple of things we have to discuss here, because why is oil so high? One, there's issues going on in Europe. Till the situation in Europe is resolved, that may slow the decrease in the price of oil. Also, it could be helpful if some of our political decisions were more favorable to oil so that we could increase the production, get the oil flowing in the USA so we can get those prices lower. Here's a chart of new vehicle average transaction price. Over to the left, around 2012, the average price was around $30,000. Today, the average price is $46,000. It's come down just a little bit from the top, but car prices really need to come down. Now, there's many issues with car manufacturing right now. Many of these manufacturers can't get the parts that they need. In some cases, they're putting together cars without all of the features that they can possibly have. So we need to see the supply issues improve in order so that we can get these cars manufactured and we start seeing lower costs. We're looking at the Zumper National Rent Report, and we're looking at the national rent growth, and you'll see out to the right, the growth or the increase in rents is starting to come down. Doesn't necessarily mean the rents are lower. Now, in a recession, typically rents don't change much. They stay pretty stable. Now, if there's an area in the country where they start to lose a lot of people, rents can decrease in those areas because demand is lower. And then if people migrate to another area, rents will increase in those areas because the demand is greater. Here's the cost of a July 4th cookout at 17% higher compared to a year ago. Let's look at some of our individual prices for our 2022 summer July 4th cookout. Ground beef up 36% this year. Skinless chicken breast up 33%. Pork and beans up 33%. Center cut pork chops up 31%. So most of the meat items have increased in price over the last year. But there is some good news out there. Let's take a look. We're looking at a chart that goes back 3 years for wheat. This is an ETF for wheat, WEAT. The price on this chart started to increase mid-2020 after the pandemic. The price continued to skyrocket higher. Interesting enough, we're starting to see the cost of wheat go lower. Now, here's what I find is very interesting. We're hearing a lot of talk about food shortages, running out of food, but if the cost of food is going down, that doesn't look like to me that we're in shortage. If we were to see shortages, we would see this to skyrocket like we saw with the price of oil. Now, it doesn't mean it can't change later, but right now the cost of wheat is coming down. We're looking at a 3-year chart for corn, ETF for corn. And again, mid-2020 price for corn started to increase. Corn's used in many products. Again, we see the price of corn coming down now. It's peaked out. So that is good news, possibly for some of our food products. We're looking at a 3-year chart for soybeans, ETF for soybeans, SOYB. Again, in 2020, the price started to skyrocket. And look what's happened on soybeans. We're also seeing the price of soybeans decrease. Soybean oil is widely used all over the world. Soybeans are used in many products. We're in the early stages of seeing interest rates increase. We're starting to see some results. Housing is one of those. We're starting to see housing costs go lower, and they'll probably continue moving lower. What we don't want to see is construction to decrease. We don't want to see the housing construction industry come to a complete halt because there's many jobs around the construction industry. We're starting to see some fuel come down. If the demand for fuel goes lower because of slowing economy, that would be good news for fuel going lower. Also seeing some commodities like soybeans, wheat, corn starting to move lower in their cost. That is good news for the food industry. Now, there will be some areas, industries where the cost just won't go lower. So I hope this information was helpful here today. I want to thank you for watching. Leave a comment if you have any comments or ideas here. Stay tuned for our next update.